and welcome back to the channel. My name is Dave, and today I want to talk about investing in ETFs when you're in that 50 plus category. So it used to be back in my 20s, 30s, and 40s, I loved growth, volatility. A stock market crash was great, right? I got to buy at those low prices and watch it ride higher over a period of time that I had. I had all that time, but now, maybe it's not when you're 50, maybe it's 55, 60, 65, but at some point, we're going to retire or head towards retirement, and we want to transition into something with less volatility, more security. So today I want to look at some products that offer just that in the ETF space. So if that is what you're looking for, please stick around. So everybody's goals are going to be a little bit different. So as I show you these ETFs that I would pick for myself, please understand they might not be right for you. I did this from the perspective of someone who wants to protect their basis, reduce volatility, and provide a little bit of income. Now, some people want to receive that income through distributions and dividends. Other people don't want that. They want to sell shares as needed. So what's your perspective? Please understand your own personal goals. And with that said, let's jump in and take a look at some of these different ETFs. So I want to start this with what I would consider a great anchor for a 50 plus ETF portfolio, and that's SCHD, which is the Schwab US Dividend Equity ETF. It's quite popular. They've got a great strategy here that they follow, and you can kind of see that play out in this first chart that I want to show you, which is the 1 year price return versus the S&P 500. So it lost 3.5% in a tough 2022, whereas the S&P lost about 11.4%. So significant improvement, right? Max drawdown, not nearly what you see in the S&P 500, and a lot less volatility overall. Now you factor back in the dividend, and we get right back to about break even in a tough 2022. So it performed really well last year. Now, what SCHD does is it follows the total return of the Dow Jones US Dividend 100 Index, and the strategy is spelled out here. I'm not going to go into it in too much detail, but pause and read through it so you understand it. But they've got great selection criteria, kind of focuses on dividend growth and dividend aristocrats. So good, solid strategy. Now, the net expense ratio for SCHD is only 0.06%, which means $6 for every $10,000 you invest. So quite affordable. It does yield 3.37%, so it is spinning off some income, and that is paid every single quarter. Now, if we look at the breakdown in the top 10 holdings of this fund, you're going to see Broadcom, Verizon, Merck, Texas Instruments, and it's really balanced. Look at the top 10 and how balanced it is. The top 10 make up about 40%. Actually, exactly 40% out of these 104 holdings. So very well balanced. And that's focused in financials, industrials, technology, consumer defensive, and healthcare. Really broad. Again, one of the reasons that people flock to SCHD. And if you look at a 10-year period, we're looking at right now, in comparison to the S&P 500, total market return, SCHD, after 2022 has surpassed that of the S&P 500 at over 240% versus 220% for the S&P 500. So one that a lot of people like, and for me, being 50 plus, I own SCHD. The next one on my list is VOO, which is the S&P 500 ETF from Vanguard. Now, if you're younger, 50-ish, right, and you're working till you're 65, maybe you can have a little bit more concentration in VOO and slowly transition out of it over a period of time. Depends on how much growth you want, so you can balance that out. And I'm going to summarize all this at the end so you can kind of play around with the numbers yourself. But I would still be investing, and I still am investing in things like VOO or VTI. So VOO has just an expense ratio of 0.03%, so extremely low. Does yield 1.6%, so it's still paying you some money. And if we look at it over a long period of time, it's going to still perform quite well. So how long do you have till retirement? Now, the breakdown is Apple, Microsoft, Amazon, Berkshire, etc. Right? So you can see the breakdown here. And if we roll out and we start looking at a 10-year return through part of that bull market, still, just like we saw with SCHD, that's about that 220% return. So how do you want to utilize some VOO in your portfolio? Is it 20%, 10%, 5%, or just get rid of it? But it's a great one to have in there to provide some growth to your portfolio, even in your 50s. The next one I want to talk about is VYM. This is from Vanguard. This is their high dividend yield ETF. There are plenty of alternatives. I like this one. I've owned it for many years. Now, the expense ratio on this one is 0.06%. They do pay out quarterly and around 3% annual dividend rate. And again, solid product. And if we look at the breakdown here, you're going to see from financials, healthcare, consumer defensive, energy, industrials, and technology. And top 10 holdings are going to be things like Johnson & Johnson, Exxon, JP Morgan, Procter & Gamble, so forth and so on, with 443 total holdings. So a little more conservative than what you're going to get in something like VOO. More balanced, and you can see that reflected in their 2022 total return, where VYM actually had a positive return last year when you factor in the dividends, versus the S&P 500, which lost nearly 10% factored in for those dividends in the S&P. So again, another solid option with less volatility. And one more reason that I like things like VYM in my portfolio in the 50 plus crowd. Also, if you compare VYM to the S&P 500 over the last 10 years, total return, all those dividends factored in, that bull market and everything we've been through since 2019, it's held up pretty well, right? Returning over 180%. Not quite what the S&P 500 did, but consider what happened last year. You didn't have that drawdown either. Actually had a positive return in 2022. Again, great solid product. The next one up on my list is DIVO from Amplify ETF Trust, better known as DIVO. Now, I've owned this one for a while. I've done a full review of it. This one, you're going to pay a little bit more for it. An expense ratio of 0.55%, about 10 or 11 times what you're paying for some of these other ones. But why is that? Well, it's a managed ETF. So what they're doing here is they've got a basket of stocks. They're picking a few every month to sell covered calls against it. So it is a covered call ETF, but not against the whole portfolio, just part of it. And for that, you're getting a higher yield, a monthly dividend paying stock that pays out about 13, 14, 15 cents every single month. It's pretty consistent based on what they do. And that yield is around 4.77% currently. So again, I've owned shares for this for a while, and you can see exactly what's in this. Again, it's Visa, Chevron, McDonald's, Home Depot, United Healthcare, Merck, Procter & Gamble, Johnson & Johnson, Microsoft. So pretty conservative and pretty well balanced, you see over here again. And if you look at the different sectors, healthcare, financials, energy, pretty good balance, right? So it's conservative from the standpoint of what they're putting into this ETF. And then they're selling some covered calls against it. Now, let's jump over and take a look and see how it's performed. So this is a one-year chart. Again, going back to 2022, tough year, lots of volatility. The S&P dropped significantly, down around 10%. DIVO up on total return about 2%. So good solid product. Because they're selling some of these covered calls, they're reducing how much growth they can have within this fund, but at the same time, they are providing some income for that. So good solid product. And if we look at a 5-year chart, because it hasn't been around for 10 years, we see that it's held up pretty good through all the mayhem since 2019, right? So compared to the S&P 500, it's right on par right there. Pretty close, slightly outperforming over the last 5 years based on total return. So selling covered calls during that period of time, it's worked out pretty good. It's reduced our volatility, put some money in our pocket. Perfect for the 50 plus crowd. The last one I have on my list today, just to spice things up a little bit, is JEPI from JP Morgan. This is the JP Morgan Equity Premium Income ETF. Now this one is a little more complex, and I'll leave my video review above. It uses something called equity linked notes. So again, more complex product, has a really high yield, and people really get excited about that. Would I put all my money into JEPI? Heck no, I wouldn't. But I'd put a little bit in, right? A little salt, a little pepper, a little JEPI for some yield. I'm okay with that. So expense ratio is 0.35%. You're paying a little bit more because it is managed. Yield 11.57%. Yes, yields a lot, pays it every single month. The yield is up and down every single month, depending on how these ELNs are performing. So it's going to be all over the place as far as what is distributed. Now, let's take a little bit of a look at what's in here. And in general, it's things like Exxon, Progressive, AbbVie, MasterCard, Bristol-Myers, Coca-Cola, right? That's 80%. The other 20% are made up of these equity-linked notes. We're up to about that. So, yeah, it's, financials, industrials, healthcare. So on the surface, it has that. But then behind it, it's got these equity-linked notes. So you have to decide how comfortable are you with some product like that as a portion of your portfolio. Now, as far as performance, and again, you got to come back to performance. If it's performing, great, right? So we're looking at price return, just price return for 1 year, 2022, tough year moving into January with a little bit of a rally. And I compared JEPI to the S&P to DIVO. And what do we see here? Well, we see DIVO outperforming all of them for price return. JEPI just slightly better than the S&P 500. But if we go to the next slide, we look at this chart, we look at total return, well now, JEPI, S&P, and DIVO. You're going to see DIVO and JEPI outperform the S&P by quite a bit. They've really moved up there, almost neck and neck. So both of these performed quite well in a down market. Again, this is kind of what we want to protect ourselves from. We want a little bit of growth, but we also don't want to have those huge drawdowns in these bad years. So the 5 ETFs that we just discussed are listed here, and I'll try to make this available for download. If you'd like it, it'll be linked down in the description somewhere. But this isn't a portfolio build. It's more of 50 plus ETF targets that I would like, maybe to start building out a portfolio. Other considerations like we got listed down below could be REITs, international ETFs, and bonds to really round out a portfolio. But it is a starting spot. So with each one, I've got some alternatives listed as well, direct or indirect. And like under DIVO, I've got U listed. So like and subscribe to the channel and you can learn all about options. So something like DIVO is very similar to what I would do in my own personal portfolio. It's not that I avoid these, I also do this. But I like to trade some of my own options as well. So like and subscribe. Now next to that is the expense ratio and the distribution yield and when those distributions get paid, whether it's quarterly or monthly. And then we got assets under management, 1 year, 3 year, 5 year, and 10-year returns based off of what you see on Seeking Alpha. Then we got the weight next to it. So how much do you want to have of each one of these? If this was just the 5 ETFs that you have in a portfolio, it should total 100. If it does, it'll tell you what your distribution ends up being. In this case, it works out to be 5% based on those weights. Then I estimated tax responsibilities. This is just an idea to get things started. I want you to think through all this too. That means your tax contribution overall ends up being 28.3% in a taxable account. So something to consider. Again, just trying to work through all the numbers so we have more clarity as we get older. We want to have clarity. And finally, down here at the bottom, I just ran through some calculations. So if you equally weighted these 20% each, and you put in $500,000 total, you'd end up at about 4.91% distribution yield, which is about $24,500 yearly or $2,000 monthly. But of course, this is non-taxable. For taxes, let's move over to here. We can adjust our weights to whatever we would like to reflect our investment style and adjust our tax rates as well based on your own personal situation. You'll see that in this case, we're going to yield about 5%, after tax 3.58%. So these would be our pre-tax dollars and our after-tax dollars. So we always want to count for the tax to see how we turn out. So those would be your numbers or some examples. So just an idea of how you might go through this. And again, this will be, I'll try to make this available for download. Not too complicated, but a good starting point if you want to get started with something like this. So I do own shares of all 5 ETFs that I just showed you. I do invest in these. I am in the 50 plus crowd. So I think they're solid products for me going forward. Happy to invest. Now, if you like this type of content, please like and subscribe. Also, lots of the information that you just saw was from Seeking Alpha. And I am a Seeking Alpha affiliate. I'm supposed to mention that. There's a link down below for a nice big discount. If you think you would get personal benefit from signing up, feel free to use that. Now, any questions at all on this, please ask down below. I really appreciate you watching. Have a great night. Take care.